We're in a time where investors are nervous about everything from inflation to Federal Reserve policy. How does cannabis real estate fit into this equation?
You shouldn't be coming to us for the high yield. You should be coming to us for the diversification within your real estate asset class of investments. What's so important about this is that all 27,000 businesses across the country that we've mapped, every one of them gets this benefit immediately for the entire tax year.
Hey there, and welcome to another episode. My name is Pascal Wagner, the host of the Grow Your Show podcast. So if you're new here, we help accredited investors grow and diversify their monthly cash flow through low risk private placements. To be clear, we're not financial advisors providing you advice on your specific situation, but our email list, our social content, and this podcast are all designed to help you learn how to find and vet passive income opportunities. So that someday when you're looking to grow your cash flow, that you'll consider working with us. And with that, I'd like to introduce Rob Sechrist, who is our guest for today. So Rob Sechrist is the president of the Pelorus Equity Group, and he's a co-manager of the Pelorus Fund, which is a cannabis use commercial real estate mortgage REIT. They've over 20 years of experience. They've raised over $750 million. And I'm a personal investor in their fund. And so I wanted to bring them on to the show because I think, you know, there's so many unique things that you can invest into. And I wanted to share some of the things that I'm looking at. So with that, let's dive in. All right, everyone. I'd love to introduce our guest here today, Rob Sechrist. Kind of just talk through, how with recent scams and the shaky economy and, making headlines, I feel like this niche is really misunderstood. And so wanted to bring Rob here on the show to kind of talk about this fund and kind of talk about all the maybe objections or things that you might be concerned with if you were going to invest in this kind of fund. So welcome, Rob. I'm excited to have you here on the show, man.
Well, thanks. I'm happy to be here and look forward to batting down some of these potential objections.
Yeah, look, so I think when we're in a time where investors are nervous about everything from inflation to Federal Reserve policy and, commercial real estate, prices are readjusting. How does cannabis real estate fit into this equation?
Sure. So happy to talk about that. And thanks for having me on the show. So the way that we like to think about it is even though we're a private mortgage REIT making monthly distributions, double-digit returns, we try to tell investors, look, you shouldn't be coming to us for the high yield. You should be coming to us for the diversification within your real estate asset class of investments. And so your real estate asset class investments, you have kind of two categories. You have your equity investments, where you're the first dollar loss leader, but you also have some appreciation potential there. And some depreciation that flows through, and some ROIs that can be from 15 to 25%, but that's not guaranteed. And then you have your debt side of it, which now you have the borrower's equity protecting you, and you have the personal and corporate guarantees that if there was a deficiency, they could be gone after. And you've got a situation where, this particular asset class is going to do better in a real estate or economic downturn. And why that's important is that you should be kind of looking at your whole portfolio. Most people have some significant exposure to real estate, whether it's through equities on the U.S. stock market or just direct or however they might be investing. And so you should be looking at whatever my allocation is to total real estate and whatever my allocation is on the equity side. Then I've got my allocation to the debt side. On the debt side, and even in the equity side, you should be thinking about, all right, how much exposure do I want in Class A? How much exposure do I want in multifamily? How much do I want in exposure for fix and flip funds? And then you're like, okay, well, wait a second. Cannabis is a totally different asset class. And that's most likely that $25 to $75 that's spent by each person in the dispensary is going to be a lot less impacted than, and if the economy starts to waffle, which I think we all expect that that's coming sooner than later, or if there's a down cycle on the real estate values, our borrowers are not selling their real estate to get out of these transactions. They're just simply making these properties more efficient in the cash flows and generating cash. And by the way, they generate 10 to 15 times more revenue per square foot than a traditional non-cannabis asset.
So can you help us dive in and understand with an example, maybe, like what does it look like that your fund does? Like you're giving, walk us through that.
Sure. So, we originate senior secured loans on commercial real estate, just like any commercial debt fund. What's different about us is that we only originate transactions for specialties properties that are with legal cannabis use tenants as the tenants for our borrowers. And so we could have had multiple asset classes within our fund, but people didn't come to us for additional exposure to real estate. They came to us specifically to get exposure to this one asset class. They're going to blend us in with what they have for their portfolio, not trying to get us to make their portfolio for them. And so a transaction would be something like this. It might be a $5 million purchase price of a commercial building. And that building might have $5 million of tenant improvements to build it out for cannabis use. So $10 million in cost basis. We would lend up to 60% cost basis. So we would put out $6 million on that transaction. But day one funding, we're only going to put out $1 million because the borrower came into escrow with $4 million. So we're and we charge on the full $6 million. Then from there going forward, each time a borrower is making a draw request, they have to put the money out themselves first. Then we check the receipts, check the invoices, proof of canceled payments, lien releases, do an inspection. And once we've verified everything, we reimburse them after the fact. So, we are in the most secure position that you could possibly be in that transaction as we're building it out. We're never putting out more money than what the value of that property is. It traded for $5 million and we only have $1 million out day one. So that's kind of the structure of our bridge lending program. We also have a fully stabilized lending program that will go up to 75% of the cost basis. But this is the type of transactions we do. What's really unique about this fund and this structure is that most real estate funds only get the collateral in the real estate, which is what we have, first senior secured lien there. But in addition to that, we also get the cannabis operator, even if it's unrelated, to pledge their company and their license as additional security. Those licenses can be worth $50,000 to $50 million, depending on where they're from each, plus the value of the company, the enterprise value of the company, accounts receivables, equipment, and all that. We blanket UCC1s on all that stuff. And why I tell you that, talk about that is we don't give any value to it. So our portfolio today is about $420 million. It's secured by $650 million or so of real estate value, but that does not include all the tertiary additional collateral that we have that we didn't give value to, the licenses, the companies, the equipment, and all of that. So if we do have to reposition something, we've got that license to be able to plug in another cannabis operator for the highest and best use.
Yeah, I love all that. So to rehash or put in kind of in my own words, it's, you're giving a loan to what would normally be an apartment building or an industrial facility, or it's the same kind of maybe note of a mortgage that you're giving out, except the only difference is it's for cannabis, for cannabis operators to be able to grow their own plant. And now walk us through a little bit of I think the first thing that comes to mind is like, ooh, sticky, maybe cannabis might be taboo. Maybe it's going to go away, or maybe it'll be legalized all across the United States. And so like, if I'm investing in this fund, isn't that like that's not really a long-term investment, or there might be a lot of risk there? How would you kind of circle back at that?
So you actually threw like 4 or 5 complicated questions in there, thinking it
all right, let's break them down.
So I'll try to unpack as many as I can that I can remember. So let me just start by just explaining to people that cannabis is only federally illegal because there's a prohibition on cannabis, similar to alcohol back in the 30s. And so when that prohibition is eventually ended, which I think will be whether it's this administration or next, at some point, state policy will be deconflicted from federal policy and that prohibition will be ended. When that happens, it doesn't make cannabis federally legal. It just makes it so it's federally not illegal. There's a big distinction there. What I'm really saying is that it's going to follow the states' rights. And so each of these states is going to have their own license, their own compliance regime and tax regime and testing and all of that. So each of the states are their own universes. Now that's for the state issued licenses. Most people in the country, probably less, 99.9998 don't know that there is a federal DEA cannabis license today. And those licenses are able to do regular banking. They're able to go public on the major exchanges. They can custody shares and investments at major institutions. They can have institutional investors. And those licenses can cross state lines and go international today. Now, those licenses, those DEA licenses, were purely created for research. There's 7 of them that are for cultivation, which we were the first lender in the country to ever lend on one of them. And that is in our portfolio. And by the way, we have equity in that company. I think almost 30% equity options in that company. And the only other company that has ever gone public with that DEA license without even having a facility had a market cap at one time of $500 million. Now, unfortunately, the operators or the sponsors of that fund were deemed bad actors later on, but it does show you the velocity of capital if you could get on a major exchange with this asset class. And that's another thing for people to understand is that every single cannabis company in the country that's an operator cannot trade on any major exchanges, which means there's no institutional capital. And I know that people think that retail capital is significant, but relative to institutional capital, it's infinitesimal. And so you're never going to see this industry go to where you think it can go, where we think it can go until that institutional capital comes in. And just so you have an idea, the size of the market from revenue is $27 billion a year currently, and is projected to be $45 billion within the next several years. $27 billion is larger than the NFL and MLB combined, just for a frame of reference.
Wow. Okay. So I guess the way I think about this investment, just like you laid out, is it's a way to diversify my portfolio. Most investors that I know, they are either all in the stock market or they are all into multifamily or, and they might be only in one of these 2 niches. And that's kind of what drew me here. What do you think are the particular risks that you see associated with this? Like what, the flags that come up, what are they?
So I'll tell you what the investors' perceived risks are, and then I'll tell you what our perceived risks are.
Oh, I like that. That's good.
So the investors' perceived risks are that, this is you're never going to be able to compete against banks. It's a very short window. This is just a short-term opportunity. And what I would say to those people is that, one, there's 804 banks doing depositor relations for cannabis today, which is more than 15% of all 4,500 banks in the country. And of those 804 banks, up to 400 of them have done lending or are actively lending today. We're tracking over 4 dozen, and we've been paid off by banks. These are both federally chartered, state chartered credit unions and community banks. So the banks were already, if that thesis was true, we would already not be able to be successful. So that number one, these are just facts. But even when cannabis is deconflicted from state policies, from federal policies, and the market opens up wider, there are all kinds of private mortgage REITs like Arbor Commercials that compete against the largest lenders in the country, which is Fannie Mae and Freddie Mac. And, if you're basically going against the government and you can be competitive, there's a path, a way through. And so all mortgage REITs, the way that they compete, Starwood and all the other ones out there, is a combination of debt and equity. And so today we have about 0.25 debt to equity leverage ratio. But over time, most mortgage REITs have 3 to 4x dollars per dollar of equity. And that's how they compete against banks directly out there and generate still the returns. Now, we think that is way too far out on today's risk profile for this particular asset. But at some point, we probably will get to a 0.5 or even up to 1-to-1 ratio at some time in the future. And that's how we can balance to compete against banks and other lenders out there. And just to go a little bit deeper on that, we prepared for this a long time ago. And there's three primary ways you do that. One is the line of credit, which is the easiest and most simple. But in the cannabis sector, it was impossible to get. We were the first one to ever get one. And then the second thing is we got investment grade rated. We brought in institutional investors, including non-cannabis friendly banks, to participate in our bond offering. And we got the highest credit rating ever issued, bar none, including IIPR, which is the behemoth of the industry, an equity cannabis REIT that trades at 2 to 3 billion market cap. We supplanted them in our rating, higher than what they got. And then the third one is securitization. So all three of these tools are different vehicles that we use to be able to deploy capital and reduce our cost of capital and compete against banks and or compete against our competitors. So today, if we wanted to, we could tighten in our rates and run away with the market, but we really don't need to because none of our competitors are able to issue any capital right now.
Wow. Okay. So there was a point that stuck out to me there. So so for every 100 million, let's call it, you are taking on 25 million in additional debt. And whereas like a normal mortgage REIT, a mortgage REIT that's lending to the apartment building next door, they are taking 4 times, like they're getting 300 million in debt on top of their 100 million.
Yeah. So they might have 200 million in equity and have $1 billion assets under management.
Wow. Yeah. Right. I mean, that's, 80% down.
It's a 4-to-1 ratio. Yeah.
Yeah. Wow. That's wild. I guess if that's commonplace, why have you decided not to do that?
So this is an emerging market, and in emerging markets, there are people still trying to figure out their business model and how that cannabis operator might work. And so there's generally going to be a slightly higher default rate here than traditionally, but a lower loss rate. And we always try to emphasize that a default, nobody wants to have report a default, but what's more important is what's the loss rate. And the loss rate is what's more important. Yeah, I could say I have 0 default rate, but when I did take one back a long time ago, I lost 50% of it. That kind of I always say you got to ask both those questions. But this is just a unique sector to a complicated sector to be in. And we want to see each of these 50 states, it's only 40 today out of the 50 that are legal, but each one is going through a maturation to a fully stabilized market. And why I'm using these specific words, I'm trying to delineate in your mind that none of the markets in the entire country has fully stabilized, meaning that the market has reached the capacity and the pricing is stabilized out. And so what keeps us up at night and what we worry about is where is the capacity for the market within each state and what's the capacity for the country. And so that kept us up so much at night, not knowing when we would reach there, which we knew it would be years away, but still it's kept us up today worrying about it into the future. We've created the Pelorus data project, and that project is a separate company that went out and mapped every single cannabis operator in the country, what type of license, cultivation, testing, distribution, extraction, who owns it, where is it situated in the real estate, how much can they grow? It hasn't been built yet, and we're monitoring the capacity for the entire state on a per capita basis. And so when we start to delineate this data, we lend on commercial buildings and greenhouses as well. And for greenhouses, we have to factor in the latitude of the state and how much sunlight there is during the growing season to factor that into the yield production. We have to factor in energy costs. We have to factor in all these things. For Las Vegas, we have to factor in tourist season. And so all this information, we can now almost front run the market to know where the best states are. What Colorado has 680 too many dispensaries per the capita right now. So we wouldn't be we wouldn't be lending into a dispensary in that state. But every other state is under capacity for dispensaries, including California and New York. But there's more to it. So these are the things that keep us up, and it's usually completely different than what investors think about. We're like, yeah, that's small ball too compared to what the things that we're thinking about.
Right. So help me understand that a little bit better. So you're sitting there and you're analyzing like how much is being sold and what's going to be yielded,
Price
so that way you can factor
capita
in the risk of lending to an operator. Is that it?
That's right. So even more granular than that, we now have such a broad base of data. We know the mean average for what it costs to produce cannabis in different latitudes for different types of licenses, whether it's greenhouse or indoor. We know what it costs to build. We know what it costs for labor. We know what the mean should be for this type of facility, and where are the borrowers coming into us for a loan, where their projections are. We can run that against our models and say, look, you're way off. We'd like you to explain why you think that you're off, why you can outperform there, or you're way off, you're underestimating based on the data that we have. So we square that up. And if they can't explain it, then we're going to underwrite and include the additional things that we know of. So we know how to add 20 to 30% in the yield to the facilities now in a consistent way. We also know how to reduce labor by 80 to 90%. And so we're going to suggest that you might want to utilize some of these best practices that we've established through doing 74 transactions across the country for more than 540 million. You don't have to do that, but you're going to have a negative competitive advantage compared to the rest of the loan book, because the entire industry is marching forward on becoming more and more efficient.
Wow, that is cool. It's so fascinating, with every additional conversation. And it's kind of what I stress when you're looking to invest in these types of things. It's like, I'm still learning. I went to dinner with Rob when we were together here in Denver. He flew out and did an investor dinner with us. And, you learn so much from every single engagement. But even now, you learn these little tidbits, and it's just part of the due diligence process. So, Rob, you mentioned this idea that you're worried about capacity. When you talk about capacity, is that in this way of, do we think that there's enough margin for operators, and so we think there's going to be an influx of people that might need loans from us? Are you trying to just...
We're thinking about it in a couple of ways. So firstly, we're thinking about it broadly. What is the universe of population in that state? What is the percentage of the population that uses cannabis? And there's actually studies on all of these data. So you can come up with a broad idea of what the universe, whether it's once a year use, monthly use, weekly use, daily use, and all that stuff. And then you factor all those things in. And so what we're really looking for is that we want to make sure that we haven't just built a facility and paid to build out a facility, and there's already too much cultivation capacity to serve that state. So that's capacity at the per capita.
So you're looking at, there are X number of other competitors to the person who's asking for a loan from you, and then you're basically sitting there and saying, hey, actually this might be too risky for us because there's so many growth facilities here, it can't even meet the demand.
Yeah. So like, for example, we wouldn't build a facility if we don't lend in Canada, but Canada, this happened. They built way too much capacity for the entire country. They could produce 5x of what the country's population is. And they did that speculating that they would be able to ship out of the country and be competitive in foreign markets. And, that some other things would develop, and that didn't happen. So, we, by the way, we did map every license up there too, just to have some more time series data. And our data is now for 2.5 years. So we're tracking all of these trends and watching it. And we're watching how each one of these states, whether it starts off as medical and then switches to recreational, or if it went concurrently, recreational and medical at the same time, and if it was a limited license state or an unlimited license state. So all of these have a different path or trajectory, but it also matters what the geography and where it is and the size of that state, and what the access is. Now, California is a massive state, and it's cannabis is legal here, but 70% of the counties it's not. And so you have a situation with 40 million plus people in the state, but there's not access to 70% of the state, just because there hasn't been stuff built there to provide legal product to them directly.
You've been doing this for 16 years now? How long have you been doing this?
The cannabis strategy, we started analyzing in 2014, and we started originating in 2016. So a little bit of time there, but we've been lenders for nearly 3 decades now.
And what were you doing before, and what was like the big aha moment that made you shift?
Sure. So we were a value add lender, which is basically what we are today, but just for a specialty use asset class. And we knew that we had the skill set to do this, but the aha moment was it wasn't as aha as you think. Our local congressman, Dana Rohrabacher, who's a friend, passed the most consequential legislation to ever pass in the country that nobody knows about. And that was the Rohrabacher-Blumenauer Amendment that defunded the Department of Justice from prosecuting any cannabis-related business in a medically licensed state. And so when that law passed, to us, this meant that this is the largest newly created asset class that we can lend on, that the tenant isn't going to be prosecuted for being federally illegal business, that we would have to, deal with that. And so my partner's like, buddy, we're going to do this. And I'm like, frick, this is going to be so hard to raise the money. And if I really knew how hard it was, I probably would have never done it, but I was dumb enough to frickin' try. So
I love it. I love it. So going to this idea that, I think the people that are tuning into the show, and, frankly, what I'm interested in is this idea of generating consistent monthly passive income, right? So, and to me, Pelorus is one of those funds that has done that. And a lot of firms choose to maybe do quarterly distributions or, in a different frequency. Tell me about why you've chosen monthly and like how you've gotten your operations to that point to be able to facilitate
so it's
that.
been an evolution, and we didn't get it right, but we didn't get it wrong. So originally the fund was a $100 million fund with quarterly distributions, and it wasn't a mortgage REIT. The reason that we did quarterly distributions is that it just is a very complicated process. People don't realize to close out the books on a fund of commingled assets and balance all the expenses, and to get that distribution out within 30 days is enormously challenging. We do it in 2 weeks from when the month ends. But when we launched the fund, I was dumb enough to think I could go get family offices and some high net worth individuals, and it wouldn't be that dissimilar to how I raised capital previously. And I was pretty good at raising the capital there. Well, as I started going into this, the first year we only had raised 1.495 million. I mean, like infinitesimal. That's not, that I could raise that in 30 minutes at the most.
Right.
And that was after 6 months when we closed the first year. And my partner and I had put in millions of dollars into the manager to operate it at the highest level possible. And there's just no money there. Now, luckily, we have other sources of income and businesses. And we were still at the time doing non-cannabis transactions also out of our firm. And then the next year, though, we were only to, I think, 6.5 million or so. And so that now we've gone 18 months, and this is a complete loss of, if you look at the amount of energy and the return on it wasn't making sense. Now, the next year, COVID happened. And that next year, we went from 6.5 million to like 52 million in 1 year. And that was a shift because people started realizing they're too heavily weighted into traditional real estate asset classes. And COVID made them really realize, I want to be diversified in something that's less impacted like us. So anyway, we realized that retail investors is the way to go. And so in doing that, along the way, we decided to upsize the fund to $250 million, convert to a private mortgage REIT for the tax advantage for the retail investors, reduce the minimums, and go to monthly distributions, because we wanted, if we're going to build it for retail investors, we wanted to build it so that they got the maximum benefit out of that. So they would get 12 times compounding if they reinvest. By the way, about 40% of our investors reinvest their distributions. So we wanted them to have all the yields and targets that we put out are net IRR. So our target yield is 12 to 15%, which we've hit every year. But if you were to add if you're reinvesting, you're looking at probably an extra, 1.5% on top of that, in addition to what if you took distributions. I think today, if you took distributions since inception, you've received about 65% of your capital back in distributions. But if you reinvested, you're at like 83% additional capital in your account. So it's pretty significant. And then the other thing is that we do have equity in transactions as well, which is super rare. If the only other people that have it are other cannabis funds like ourselves, but we were the ones that came up with the strategy. And we've got options for warrants in 8 transactions out of our 32 transactions. And that we don't count that in our yields, like some of our competitors are baking that in. We think that that's a bad strategy, because those are going to go away when there's more competition out there in the sector. We think that probably these 8 are the last that we'll get, but the amount of pent up net equity value that's there is it. If any of these hit are major. I'll just give you an example of one. Is a publicly traded company that our option price is 5 cents. And it's trading at 5 cents right now, between 5 and 6 cents. Now, this is retail investors, and it's got a lot of volatility, but it's pretty consistently there. Just to kind of give you an idea, if it goes from 5 cents to 50 cents, we 10x'd that value. So it would go from 3 million to 30 million. If it went to $5, we're talking 100x. And so it goes from 3 million to 300 million. Most likely we don't get to monetize all of them, but even one of them, that's just one company. And that company could easily get there. So we own up to 30% of that particular company. And they've traded as high as 384 before, when they weren't even profitable.
Yeah. When do you expect those to shift in the market?
Yeah. So we actually have some clarity a little bit there. So there's 2 major things happening in the cannabis sector. One is the HHS has recommended to reschedule cannabis from Schedule 1 to Schedule 3.
HHS?
Health and Human Services.
Cool.
And why that's so important is that for cannabis businesses, they're not able to write off any expenses on their federal tax returns. So now they would get a 40 to 50% net uplift to the bottom line on their federal tax returns and profitability for the company. So that's major. That recommendation has already happened. So that's been done. Now we're just waiting for the Department of Justice to accept it or decline it. And I just can't imagine a world where the only reason that HHS moved forward on it was because the executive branch directed them to, and the executive branch directs the Department of Justice as well. So I can't imagine Garland is going to be opposed to it.
So just, picking up a tidbit here, I mean, I would imagine that all cannabis companies, at least in the United States, that trade publicly now would be it's not financial advice, but now would be a great time to invest.
Let's just put it this way. That response is supposed to come. My understanding is that response from the Department of Justice has to come within 90 days. We're 40 days into it. So we should get the confirmation sometime this year. That doesn't mean that it happens that day. That just means that they've recommended to do it. Then there's a little bit more process to it. There's going to be an implementation period, a comment period, but most likely there'll also become a Department of Justice memo that comes out that would be similar to what the Cole memo was under the Obama administration. And that will give the framework of how to work without utilizing Congress. And so what's so important about this, that all 27,000 businesses across the country that we've mapped, every one of them gets this benefit immediately for the entire tax year. And they theoretically should be able to carry the non-operating losses forward from the previous years. They might even be able to carry the taxes that they paid possible. We'll have to see where that ultimately get worked out, but it's massive. This is the most massive thing that could possibly happen. It also clears up some other issues for anti-money laundering, because now you're not Schedule 1, you're Schedule 3. So it clears up some custodial issues for how shares are held. And so we might, that rescheduling plus the Department of Justice memo that we think has to come with it to provide additional clarity of how they're thinking about it. It's basically, we promise not to prosecute as long as you are agreeing to operate within these things. Very similar to the Cole memo, if you want to look that up. I think it had 9 things that you need to comply with. So these are significant. Now, safe banking, I just met with Senator Daines 2 nights ago. He is the co-sponsor of safe banking in the Senate, and the Senate has always been the choke point that they have not been able to get the 60 votes necessary to get through the filibuster. He has previously, we communicate often, and he had previously let me know that he had the votes. He had 17 votes, so they had easily superseded it. But now, when I just met with him last night, because of all the hand-wringing in the House and McCarthy getting knocked down, he said, look, I'm going to put the brakes here and slow this down until I see there's a clear path through on the House. And the reason he's saying that is that he's like, I want to make sure this actually goes through, not just goes to die in the House like it's done. The House has passed it many, many times, and it just goes to die in the Senate. So a lot of people were upset with me sharing that, but it's I think that the more important thing to focus is that he's trying to get it done, not just the political press release, you know.
So there's a lot of stuff happening in this cannabis industry. There's a lot of pro, and I imagine in that case, it just makes your like all the investments that the fund makes even safer.
Yeah, so that's a great way of looking at it. So our strategy works regardless. So we've underwritten everything the way it is with, you know, we want a 1.25 debt to income service ratio, or DCR, but we typically underwrite to 2 to 3x, and we have transactions trade that are at 6 to 7x. So this sector is just an anomaly, and it theoretically should only get better and better, but more and more competition will eventually come in, but they don't have the tools that we have. They don't have that investment grade rating. They don't have the ability and the capacity to do bonds yet, and they certainly haven't figured out how to do securitization. So we've got the framework, we've got the data project, we've got the landscape, we figured it out. Everybody knows who we are. So it would be very difficult to catch up to us and do the size and scale of transactions we do.
Yeah. And I mean, you know, not to sound too much like a sales pitch here, I'm an investor, so I'm bought in, and I want other people to get to know this, right? Like these are like, I want people to trust what's coming out here, but, and also the idea is, okay, if someone, you know, if things changed in the market, you have the ability for someone to exit out of the fund. It's not like you're holding the money for 10 years. And there's like a little bit of gating that you have. Can you talk about that?
Yeah. So happy to talk about that. So we're a fund that has notes in it. We've got 32 transactions for $420 million, and we've got investors coming in and out at all times. And we have 2 fund limits. We have a fund member level limit and a fund level limit. So when an investor wants to redeem after the 6-month lockup, they get the greater of $50,000 per month, or 1/12 of their account if it's a large account, more than $600,000. And that's how it's structured, so that the fund never has to sell something to be able to provide liquidity. You wouldn't want that. And so the goal here is to provide robust liquidity to investors without hampering the fund in any way, shape, or form. Now, on the fund level limit, we have a limit of no more than 2% of net assets under management to be released under any 1 month, 5% in any 1 year, or 20% in 2% for a month, 5% for a quarter, and 20% for a year. And so occasionally we have investors coming in and out at all times. There's always people adding in and exiting. We're open-ended. So, you know, people, that's just part of the process. There's been multiple times in the fund's career where there might be the advantage of being with a private fund is there's no volatility of the stock market. The disadvantage for the fund manager is there's no volatility in the stock price, share price. And so when there is a massive shake in the liquidity of the stock market or volatility like last year, we get a big wave of people that need liquidity. And it comes in a big lump. I mean, I think in one last year, at one time, we had 40 people come in one day needing liquidity. And that's because they don't want to have to sell their stocks at a discount. And so we want to provide that liquidity to them. But even with that many, at once, and with the fund member level limits, we didn't hit capacity. Now, there's been other events in time where we came close. Earlier this year, we did just barely have to put the limit up on the fund member, on the fund level limit up. But I think it's important to understand what that means. A lot of people use the word gating, and that's not the right level. Gating means that you are not able to honor your requests, and you're having to gate and block the money coming out. We are actually not gating. We're limiting. And what we're doing is we're providing liquidity to every single investor that's requesting capital. Every single one of them is getting their pro rata share of what's available for that particular month until we work through that period. So the time that month that went into effect, we had about $1.5 million more requests than what's available. We could have easily pay it. We're sitting on tens and tens of millions of cash, but that's not how you look at it. As a fund manager, you have to operate by the offering documents and stay consistent with how you think about things, because you're trying to balance providing reasonable liquidity of what you agreed to doing, not gating, but limiting if this ever happens, and making sure that the fund remains robust and has ample cash flow to do everything it wants to do.
I love it. One thing, so thank you for answering that question. I think one of the scary things that I think when you're investing in these different types of assets is just how liquid is it? Like how can I get my money out? And so I'm glad we went into that. Yeah. I want to jump over to maybe like one of my last questions is let's talk about Federal Reserve policy. So the Federal Reserve has been raising interest rates for the last year, and it's had a huge shakeup in the market, and now it's kind of leveling off a little bit. How do these interest rates affect the cannabis market specifically for what you're doing?
Yeah. So there's two sides to it, how to think about it. So from our borrower's perspective, we're not selling off to Fannie Mae and Freddie Mac. So we're not tied to that in any way. So everything is held on our balance sheet. So it doesn't impact us or our borrowers unless we want it to. Now, the only place that it impacts us is that we do have a line of credit. That line of credit has a floating rate, but it's prime plus one. I mean, it's not a big deal. And so the part that it impacts the fund the most is that when we're putting up double-digit returns, annualized net, compared to T-bills at 0.75 is one disparity. Okay, plus 10, more than 10, 1,000% or 1,000 points, as opposed to T-bills being at 5, and we're still at the same. That disparity has changed, and so that's the most difficult thing to think about. And I try to tell people, look, yes, the T-bill is the best investment you can do, but there's one other part that people forget about. You have to hold to maturity, or you don't get that yield. So I just want to make sure that you could have been back at the 3% rate and thinking, I'm freaking hit a home run. It hasn't been here in my entire life. And now it's at 5%. And now you're going to have to sell that 3% at a discount if you need it back, or you got to hold it all the way to maturity. And so right. I think that most individuals are not sophisticated to think all the way through their first. They're not thinking second order risk through, because they're only looking at top line risk. And I think that that's the biggest problem with retail investors when they're thinking about things. They are not in the industry deep enough to know second orders of risk, which could far outweigh first order of risk, what is perceived in their mind.
I love this topic. I would love to go down a rabbit hole here if you have more insight, or it's like I myself, it's if you're not doing this every day and you're someone who's got their day job and your W-2, it's understandable how you wouldn't be as sophisticated as professional institutional investors. I would love to highlight a couple of those if you can think of any in detail.
Well, so I think that was a really easy one to show. People may not understand what I'm saying. So what I'm saying is that when you have a 10-year T-bill at 3%, and
like you go into treasury.gov and you put $100,000 on a 10-year T-bill because you're like, oh, it provides a great rate. I don't need it for a long time. That's what we're talking about.
That's right. And so you're going to get back that T-bill plus the yield, or you'll get the yield over if it's being dispersed, depending which type you take. But if the rate if the market rate goes to 10, you actually are going to be taking a loss unless you hold that to maturity. So you have to start running the models. Okay, I can sell this today and I have to sell it at a loss. I have to take a discount on it to get back to the buyer being at par, and I have to incentivize him to be able to buy it. So whatever, even though the repayment of it is going to be for sure, the problem is the yield is not guaranteed because you have to put discount in the rate. Then you're like, okay, how far are we from the maturity of this? Can I make more by selling it today and re-entrenching it back into the T-bill today at 5%? And you have to run those models. And so that duration risk is something that I don't think people probably even ever heard of in most retail investors don't know what duration risk is. There's more than one type of risk, and that's duration risk.
All right. Yeah. I mean, similarly, it was, I bought $1 million in bonds earlier this year and held them for 6 months. And very much, you learn that you only earn that maturity, the interest on maturity. And then second off, if you sell it, you actually, like in the meantime, you didn't earn the interest along the way like you do in these types of funds that provide monthly income. You have to sell it at a discount, and you lost money, and you didn't even, the opportunity cost is huge. So that was a huge lesson that I learned. I mean, I didn't sell them. They all matured and everything was fine, but definitely something that goes into my thought process now as I'm evaluating all the different vehicles to invest with.
So this is the primary reason that all the banks, community and regional banks, are struggling. They all overweighted into the most safe and secure investment there was, but now they have a duration risk. And so now they're sitting there going, we don't have the ability to free up deposits, to free up money for people requesting withdrawals out of our bank. And now we have to sell these at a discount. That is the worst possible situation you can be in. But that's actually do it.
That's actually what happened to Silicon Valley Bank, right?
Yeah, Silicon Valley. All the banks are facing this specific issue right now, and it's getting exacerbated because the Fed lending rate ran for so long at so low that there's like a generation of kids that have never known that it can move this. It's never moved this fast, this quick. But there's people that don't even understand that was possible.
All right.
And so
we could get into it for sure. So, just to wrap up here, like any kind of opportunities or just things that we should be focused on as we, someone's thinking about the cannabis space and evaluating different funds.
So like I said, like where we started, I like to think about it as diversification of your risk. And so you've got your entire portfolio of what you're investing, and some of it is going to be in equities, some of it's going to be in debt or alternatives, and you just want to be thinking about, okay, I'm going to do this much money in bonds. I'll do this much at which you can get a zero coupon rate on it as well, where it compounds. So there's all kinds of different ways you could do bonds, by the way. And by the way, never buy them through a brokerage. Always buy them direct. But all of these things that you should be thinking about in your design, thinking about your portfolio risk, and you don't need to go to an asset manager or a registered investment advisor to think about this. Just so you're like, look, I love multifamily. It's been crushing it for 30 years. Or I love Class A. It's never gone bad since that one time in San Francisco in 2002 or the dot-com era or whatever it was, and it's like, yeah, until it's not. And so almost all asset classes are going to have some risk in some period of time. It just might be a longer horizon. And typically the longer the horizon, the bigger the correction could be. So, I mean,
like
Class
we're
A,
seeing with commercial
Class
real
A
estate.
office space, man, you don't know whether you're actually going to be the smartest guy at the entire table by scooping everything up in the inner city core for Class A. And you can hold that on your balance sheet today with cash. And you're like, look, I'm thinking 30 years down the line, and you're probably going to be okay. But, maybe the economy and the way that the workforce works going forward and AI, no, they don't need people ever again at that level. I've got a really interesting story if you got just a second. So I got to meet NVIDIA last night, one of their top executives. And there was a couple of takeaways that I got from that. And it just helps me think about how I think about risk in the world and how it's changing. And the three things were, one is that they committed to doing Earth 2.0. And what that is that NVIDIA, who is the number one manufacturer in the world for artificial intelligence, they are spending $500 billion to model the exact Earth in a virtual environment. And why that's so important is that today, predictive weather can only go out 8 days before it falls off the chart, and it's just not useful. Right now, they're only 2 years into the project, and this will be this probably be a 10-year project. They can already predict 6 weeks out in almost perfect accuracy just from that modeling. And so you can just kind of see like hurricanes or global warming, whatever you want to run on that scenario, world war scenarios. Like you can see how a volcanic plume, you could see how you've got now every single variable built for a duplicate world. So now you're not guessing into modeling. You actually have a artificial intelligence created one. And I mean, it's $500 billion that they had to put the processing power to do it. And so that was one that I was just blown away. The other one, I used to write code when I was a kid. And the other one I learned is that artificial intelligence, they tell it to write it, but it writes the code itself. Okay, that's not that mind changing for me. But when they told me that when it writes the code for itself, they don't understand the code it wrote. Nobody can unpack what the code or how it's working. I'm like, nobody? They're like, no, we have no idea how artificial intelligence is coming up with hallucinations. We can only give it guardrails of how we tell it to think about things, but we have no clue. And I'm like, holy crap, that's crazy.
Yeah.
It just blew my mind that we don't know how it's writing the code. And even if we looked at those ones and zeros in the lines of code, we wouldn't understand how it was interconnected. I was like, that is crazy. And then the other one was artificial intelligence will never be dumber than it is today.
Yeah, fact. I mean, we're already seeing that with ChatGPT. Yeah.
And they said that the world that the retail investor, the retail persons in the country don't realize we've already moved in the artificial intelligence age. CPAs, lawyers, all these jobs there are in 10 years going to be like 5%, if even that, of what they are today. And most of those jobs will probably be cut in half in the next 2 to 3 years. And so I was like, okay, so maybe that bet that you thought in 30 years on Class A office, which a day before I could have been the investor making that investment, I would now be going, okay, I need to think about things a little bit differently. The world has changed. And so not all past scenarios of history are going to play out the exact same way or at the same speed as they have previously.
That was the golden nugget of the interview. I love it. Thank you so much, Rob, for joining us today. This was awesome. I really enjoyed it. It was very much a continuation of what we had at dinner, and I hope we get to do it again.
Yeah, me too.
Cool, man. Thank you so much for joining us.
You bet.
All right, now some final thoughts for our listeners. There are over 350 of you who are already signed up on our email list, but if you are not already, if you'd like to get access to our database of private investment opportunities that we see every week, and you want to see the opportunities that we put together at Grow Your Cashflow, you can join our investment club at growyourcashflow.io. Now, if you found this particular episode helpful, don't forget to share it with that friend who might benefit. And lastly, if you have any questions, suggestions, or just love a particular episode, feel free to reach out to me on Twitter at Pascal Wagner 1. Thanks for joining us, and I will see you on the next show.